Ethics in accounting are concerned with how to make good and moral choices in regard to the preparation, presentation, and disclosure of financial information. The ethics that are held by management and accountants will determine the accuracy of an entity's financial reports and information. If it is found that an entity or its management has poor ethics, there can often be pressure placed on the accountant to deliver results that are considered desirable by management, the stakeholders, or the market. This undue pressure can often be the reason for fraudulent or false reporting. The greatest motivator behind fraudulent accounting is the desire to report higher levels of profit and revenue in order to appear more attractive to investors, lenders, and potential purchasers. A better performing company is more likely to receive financing from banks and other lenders for further investment. Regulating authorities, such as ASIC, implement standards in order to restrict a company's ability to act in this way. However, despite tight regulations, the business world has regularly seen fraudulent reporting being prepared by companies and for a variety of motivations. One of the most renowned cases of this occurring was a company in the United States called Enron, who traded in energy services and was one of the largest businesses on Wall Street. It was found that the company was recording profit using a technique known as mark-to-market accounting, where you can claim profit of an asset built by the company, such as a power plant, based on projections, even if that asset is yet to earn income. What Enron would do is if an asset's profit margin was less than what was projected and already reported on their books, the asset would be transferred to an off-the-books corporation and the loss would go seemingly unreported. As is the case for most accounting fraud, share price, the desire for increased investments, and the need to hide increasing liabilities was a strong motivator behind the Enron scandal. Positive financial results, particularly those showing growth, is attractive to investors, meaning they are more likely to buy Enron shares on the stock exchange. This increased investment ultimately results in an increase to the value of dividends available to be distributed to shareholders. This is an example of agency theory, whereby a principal employs the services of an agent to perform some activity on their behalf and delegates the decision-making authority to the agent. Agents can feel the pressure from principals or stakeholders to ensure that financial results are positive and desirable, and this is what tends to lead accountants into preparing fraudulent or misleading financial reports. In 2015, an investigation found that Toshiba were reporting false profit results by overstating revenue and understating actual costs on projects. Following the scandal, an analysis showed that accounting scandals happen because there is pressure to meet short-term market expectations in terms of financial and share price performance. At Toshiba, executives put top priority on financial results for the current accounting period, placing severe pressure on subordinates to improve the figures for their business units. Faced with no alternative but to bend to executive demands, those lower down in the company turned to cooking the books. It has been detailed that further motivation behind the Toshiba case was another example of agency theory, whereby managers, bonuses and share options are linked to the financial performance of the business, encouraging fraudulent reporting in order to benefit the individual.
Another major ethical issue that can affect the business is insider trading. Illegal insider trading generally refers to the buying or selling of a security which is in breach of fiduciary duty or other relationship of trust and confidence while in possession of material non-public information about the security. On the other hand, illegal insider trading is the purchase and sale of stock in one's own company that is reported to the Securities Exchange Commission. Accountants are in a position to be privy to a lot of information in regard to businesses that may not necessarily be available to the public, and the temptations to use this information for financial benefits are apparent. Managers of businesses also potentially have these temptations, as they are the stakeholders that are making decisions before they go public, and these decisions can directly affect the share price of a company. Stakeholder theory suggests that a stakeholder is just about anyone who is affected by the company in question and its workings, and therefore you would assume that managers, shareholders and accountants preparing the work would all be stakeholders of the firm, and that any unethical decisions made directly affect them. Managers who are agents for the company have a fiduciary duty not to do anything illegal or make decisions that would unfairly affect other stakeholders which include shareholders, suppliers, employees, etc. An example of a possible insider trading issue could be a manager and an accountant that could come across some information in a meeting that was held and a decision has been made but not yet been made public. This decision in itself may not be material, but when you combine this with some publicly accessible information, it is easy to see that the share price will go down substantially. The manager shares the information with their accountant before the meeting decision goes public, and then the accountant and manager sell their shares. And then the meeting announcement goes public, and then the shares drop significantly in price. You can see in the above example that the manager and accountant could try and make a justification for the information not made public in itself was enough to make their decision unethical. However, the question they would need to ask themselves, would they have sold these shares if they didn't have access to this non-public information? And I believe the answer to that question would tell you if the decision was ethical or not. Once the public finds out about these types of decisions made and how certain stakeholders have benefited from information that was not available to everyone, the damage to the company's reputation can be detrimental to the future value of this company. Not only the company, but the firm the accountant works for could also suffer as well, as its name will be plastered through the newspaper, and even if only minor in nature, the public's perception of this was still very bad and could potentially ruin businesses. An ethical issue that is presently being contested is in relation to legitimacy theory, which outlines companies' responsibilities in aligning their values and behaviours so that the expectation with that of the expectation in society. The Banking Royal Commission is an example of unethical behaviour or uncovering unethical behaviour that is in line with legitimacy theory. The Commission has found that some major banks in Australia, including the Commonwealth Bank, were allowing forms of revenue to be earned by means that have been considered wrong and unethical. For example, charging deceased members for financial services. The Commonwealth Bank would argue that this could be an administrative oversight, yet the public will always see this as a big organisation taking advantage of little people. Further to this, it was found that the Commonwealth Bank did not disclose information historically about involvement in not correctly tracking deposits made in their ATMs as a part of an anti-laundering behaviours. By not disclosing this information, stakeholders were not given historic view on any potential financial and reputation damages that could be made. The behaviour is another example of legitimacy theory and how not aligning to societal values can affect the value of the price and company, in turn affecting current and potential investors. In summary, ethical behaviour by firms, whether actual or by perception, is very important for the reputation and ongoing success of any business. Big businesses come under the spotlight of ethical behaviour, and public expectations of these companies and big businesses will tend to be a lot higher, as these companies are meant to be setting the benchmark for good, sound, ethical practices. If these practices fail, I believe we have proven in our statements above that a successful business can suffer for extreme financial loss, not only affecting the business itself, but everyone involved, including small shareholders, small investor groups, and any other stakeholders involved.